Traditional mortgage versus HELOC versus all-in-one loan. Which one gives you the most financial flexibility? Most people think a mortgage is just money you borrow to buy a house and then pay back for 30 years. But there are actually different ways to structure your access to your home's equity and cash flow. First, the traditional mortgage. This is the basic setup. You borrow, for example, $300,000 to purchase a home, make your monthly principal and interest payments, and gradually build equity as you pay down the balance and potentially as the property appreciates. The advantage is simplicity and predictability. The downside? Once you need additional money, your mortgage doesn't automatically give you access to that equity. You generally need another financing product. Second, the HELOC. A HELOC is basically a revolving credit line secured by your home. Let's say your house is worth $400,000 and you have $200,000 left on the mortgage. You have approximately $200,000 in equity. A lender may allow you to borrow against a portion of that equity through a HELOC. The major difference is that you don't necessarily receive all the money up front. You can draw money when you need it, repay it, and potentially borrow again during the draw period. HELOCs commonly have variable interest rates, so your payment can change. And because your house secures the debt, failing to repay it can put your home at risk. Consumer Financial Protection Bureau. Now the interesting one, the all-in-one loan. An all-in-one loan combines mortgage financing with a transaction account and access to your available equity, depending on the lender and specific product. Instead of your money simply sitting in a normal checking account while you're paying mortgage interest, the structure is designed so your available cash can reduce the balance used to calculate interest. So if you consistently have extra cash flowing through the account, you may be able to reduce interest and potentially pay the loan down faster. Here's the easiest way to remember it. Traditional mortgage, can't you borrow and pay it down. HELOCs harm borrow against your equity when you need it. All-in-one was mortgage plus cash flow management, plus potential access to equity in one structure. But don't automatically assume the all-in-one is the best option. Compare the interest rate, fees, access rules, repayment terms, and total cost against a traditional mortgage and HELOC. The real question isn't which loan sounds the most sophisticated. It's which structure gives me the lowest total cost while giving me the flexibility I actually need. That's how you should evaluate financing, not by the monthly payment alone.